Think of the housing market as not just faltering, but bursting so quickly it could erase trillions in U.S. wealth within months. We're facing a fierce mix of soaring prices, climbing interest rates, and shaky jobs, a cocktail that makes 2008 look tame. Major banks have the data but are keeping quiet to dodge mass panic. Today's numbers are right now truly eye-popping, and if you own or invest in property, listen up. The fallout could be enormous and long-lasting. Let's break it down. Mortgage applications have taken a nosedive. Think about a 60% drop from their high point during the pandemic. To put that in perspective, during the worst of the 2008 meltdown, applications fell by only 30%. And if you thought things were slowing down gently, think again. In just the last 3 months, we've watched another 12% slide. This isn't a smooth slowdown. It's more like watching a boulder roll off a cliff. What's behind this cliff dive? At its core, we're facing an affordability crisis, the likes of which we haven't seen before. The National Association of Realtors keeps track of how easy or hard it is for Americans to buy homes, and right now their Housing Affordability Index is at its lowest point in over 40 years. In plain English, the average family today needs to pull in more than $115,000 a year just to qualify for a loan on a middle-of-the-road house. Meanwhile, the actual median household income in the U.S. is about $75,000. That's a shortfall of $40,000. Money most families just don't have lying around. Imagine saving every penny you can, cutting back on takeout, streaming subscriptions, even your daily coffee, only to realize you're still tens of thousands of dollars shy of the income you need. That's the reality for millions of would-be home buyers right now. To see how extreme this is, let's take a quick trip through time. Back in the early 1970s, you could buy the average home for about 3 times what a family made in a year. Fast forward to the peak of the last housing bubble in 2008, and that ratio had climbed to roughly 4.7 times annual income. Today, we're staring at a jaw-dropping 6.8 times. In other words, houses have become almost 7 times more expensive compared to what people earn, and that math just doesn't work for everyday families. This gap isn't just a number on a chart, it's a real-life barrier. Young couples dreaming of their first home are stuck renting or moving back in with relatives because there's simply no way to bridge that income chasm. Parents who hope to downsize and help their kids get started are finding they can't sell their own homes without pricing the next generation out of the market. For anyone who's built wealth through real estate, whether you're a homeowner who's watched your property value climb or an investor with a portfolio of rental houses, this shift matters. The pool of buyers who can afford your homes is shrinking fast, and as fewer people qualify for mortgages, you might find yourself with empty properties or forced to lower your prices just to attract interest. In short, we're in uncharted territory. Mortgage applications are plummeting, houses are out of reach for a huge slice of the population, and the traditional path to homeownership is starting to look more like a steep mountain than a gentle staircase. If you've been banking on real estate as a steady way to build and protect your wealth, it's time to pay close attention, because the next wave of buyers simply might not be there. Now, imagine stepping into a time machine that whisks you back to 1890, when the average American home, once you smooth out the ups and downs of inflation, sat at a comfortable, predictable level. For more than a century, from that year until the late 1990s, housing prices hovered around that same steady line, sometimes drifting a little higher or lower, but always snapping back to the norm. Then, as if someone hit the gas pedal, prices began to climb with breathtaking speed. By the peak of the 2008 crisis, homes were roughly 35% above their long-term trend, a spike that felt enormous at the time. Fast forward to today, and we're staring at values nearly 80% above that same historical average, more than double the height of the last bubble. When you lay out the data on a chart stretching back 134 years, you see a long, almost flat ribbon of stability until about 1997, and then a jagged, soaring line that towers over everything that came before. It's a visual shock, especially because so few people have actually seen this graph. It shows in stark detail how prices stayed surprisingly calm through 2 world wars, the Great Depression, and countless recessions, only to explode in the past quarter century. That explosion makes the 2008 surge look like a small hill compared to the mountain we're on now. What's driving this record-shattering run-up? Back in 2008, the culprit was clear: subprime loans and risky mortgages handed out like candy, fueling a frenzy of flips and foreclosures. When borrowers couldn't keep up with their payments, they were forced to sell and prices plummeted. Today's situation feels eerily different. Lenders have tightened their standards and buyers generally have solid credit and real incomes. Yet many of these qualified buyers are choosing to sit on the sidelines, wary of overpaying or getting trapped by rising interest rates. Instead of rushing in, they're watching, waiting for prices to cool off, creating a strange standstill where sellers expect top dollar, but fewer buyers are willing to pay it. For anyone who has spent decades building wealth through real estate, this historical perspective is vital. The market conditions that fueled steady gains for generations, predictable price growth, easy access to credit, and regular cycles of boom and bust, no longer apply in the same way. We've entered a phase so unprecedented that it threatens to wipe out significant portions of the equity people have accumulated. Imagine watching your life's work hang in the balance, knowing that the usual safety valves aren't there to cushion a fall. It's tempting to assume that because markets have survived past shocks, they'll find a way through this one too. After all, history does show a remarkable resilience in housing values. But this gap between today's prices and the long-term average is the widest ever recorded in American housing. That isn't just a footnote in a dusty report, it's a flashing warning sign. The bigger the bubble, the harder it can pop, and without the distressed sellers and foreclosures that defined the last crash, there's no clear release valve for all that built-up pressure. None of this means a collapse is inevitable tomorrow. Markets can stay irrational longer than anyone expects, and prices could keep climbing even higher for a while. But understanding the scale of this bubble and how different it is from anything we've seen before can help anyone thinking about buying, selling, or holding property to make smarter choices. Knowledge of this unique moment in history is like having a map when you're standing at the edge of a cliff. It doesn't tell you exactly what will happen next, but it shows you where the ground ends. So take a moment to picture that 134-year chart again, with its long, flat baseline suddenly overtaken by a dizzying spike. Remember that this isn't just another market hiccup. It's the most extreme deviation from the norm that American housing has ever recorded. Keep that image in mind as you navigate today's market, because understanding the past is the best way to prepare for whatever comes next. For decades, the Federal Reserve was like the puppet master of the housing market, pulling strings behind the scenes by adjusting interest rates to keep things stable. If the market overheated, they cooled it down. If things got too cold, they turned up the heat. But now, it looks like they've lost their grip. Mortgage rates, especially the popular 30-year fixed kind, have shot up past 7.5%, more than twice as high as they were just 3 years ago. That's not just a temporary blip, it's a huge shift in how things work. And for once, the Fed doesn't seem to have the tools, or maybe the power, to stop it. Let's talk numbers for a second. Back in March 2022, the Fed started hiking interest rates to fight inflation. Since then, they've raised their key rate by about 500 basis points. And mortgage rates? They've jumped almost the same amount, around 450 basis points. That's unusual. Normally, mortgage rates only move at about half that pace when the Fed raises rates. So what's going on? Experts say this points to bigger cracks in the system, especially in the credit markets. One red flag is the gap between the 10-year Treasury yield and the 30-year mortgage rate. That spread is now way wider than usual. Why does that matter? Because it signals trouble in the mortgage-backed securities world, the same part of the system that helped cause the 2008 financial meltdown. Speaking of 2008, remember how the Fed swooped in and slashed interest rates from 5.25% down to nearly zero? That move helped save the housing market back then. But today's situation is very different. Inflation is still high, and the U.S. national debt has exploded past $35 trillion. So the Fed doesn't have the same wiggle room. They can't just cut rates without risking even more economic chaos. On top of that, the Fed's own balance sheet is shrinking fast. It had ballooned to almost $9 trillion during the pandemic when they were buying up assets to inject cash into the system. Now, through a process called quantitative tightening, they're yanking about $95 billion out of the economy every month. And they're doing this right when the housing market is at one of its most fragile points in years. Bottom line, the Fed isn't holding the reins like it used to. Mortgage rates are climbing on their own, driven by deeper issues the Fed can't easily fix. And for home buyers, sellers, and investors alike, that's creating a storm of uncertainty, one the usual playbook just can't calm. If you've been counting on rental homes or flipping houses to fund your retirement, you might want to sit up and pay attention. Things are shifting fast and not in your favor. For years, many of us assumed that whenever the market wobbled, the Federal Reserve would swoop in, cut rates, and get real estate prices back on track. That safety net, it looks like it's fraying. All across the country, houses that once flew off the market are now sticking around. In big cities and small towns alike, the number of homes for sale has jumped by about a third compared to last year, and in some spots, it's literally doubled. What used to take just 3 weeks to sell is now lingering for 2 months or more. Imagine your property listing going from a 21-day sprint to a 63-day marathon. That's a 200% slowdown in buyer interest. And it's not just patience wearing thin. Nearly half of all sellers are chopping their prices to make a deal happen, up from just 15% a year ago. That's right, almost 42% of listings are seeing price cuts. Builders are feeling the pinch too. The NAHB Housing Market Index, a barometer of how confident home builders feel, has tumbled to depths usually only seen when the economy's in a ditch. In some areas, nearly a third of new home orders are being canceled, pushing builders to roll out the red carpet, offering discounts, free upgrades, or cashback equal to up to 15% of the home's sticker price. All of this means one thing. If you've stashed your nest egg in bricks and mortar, it might not hatch the way you hoped. Buyers have the upper hand, sellers are scrambling, and the Fed's traditional playbook isn't working its old magic. It's time to rethink your retirement game plan because the real estate world you knew just got a whole lot more unpredictable. You might have noticed the housing market acting a little strange lately. Big investors, think huge companies that buy up homes to rent out, have scooped up over 800,000 single-family houses since 2010. But here's the kicker. They've cut back their buying by a whopping 70% compared to last year. And this isn't just a few whispers on the street. It's backed up by hard numbers from coast to coast. Even more eye-opening? What took nearly 2 years to play out during the 2008 crash is now happening in just a few months. That doesn't mean every corner of America is seeing the same changes at the same time. In fact, where you live right now probably shapes how you're feeling the market's wobble. Let's take a quick road trip through the regions and see what's really going on. If you live in San Francisco, you've probably seen for sale signs hanging around longer than before. Sales there have tumbled 40% compared to this time last year, and median prices, basically the middle price you'd pay, are down anywhere from 15% to 20% from their high water marks. Up in Seattle, sales are off by about 35%, and homes are selling for nearly 10% less than they were at their peak. It's like these coastal cities, which usually set the pace for the rest of the country, are the first dominoes to fall, often 6 months to a year before others feel the shake. Head a bit south and you'll see a similar story, but with its own flavor. In Phoenix, home sales have dropped 35%, and median prices have slid 10% in just half a year. Over in Las Vegas, the number of homes on the market has shot up by 170% compared to last year. Imagine nearly triple the usual inventory, with open house signs practically begging for visitors. Austin, once a poster child for fast rising prices, has seen its median home price dip about 28% from its 2022 high. These Sunbelt spots were full of people betting on quick gains, and now we're seeing just how fast that kind of market can deflate. Out in the Midwest, the luxury scene in Chicago is feeling the pinch. Homes priced over $1 million are now listed for about 25% less than they were just months ago. Detroit, a city still bouncing back from years of decline, has seen sales fall 29% and the number of homes up for grabs climb 45%. And if you're in the Northeast, things have held up a bit better until you look at the suburbs around New York City, where inventory has jumped 60%. Think of it like a wave. It hits the West Coast first, rolls down through the Sun Belt, and is now crashing into the Midwest and Northeast. Why should you care? You don't need to be a real estate pro to see that this correction, fancy talk for prices cooling off, isn't a slow, gentle breeze. It's more like a fast-moving storm. For buyers, that could mean better deals if you're patient. For sellers, it's a reminder that timing is everything. And for renters, it might ease some of those sky-high rents we've seen as investors hoarded houses. So next time you drive by an open house or scroll through a real estate app, remember, these shifts are more than local oddities. They're part of a national story playing out faster than most of us expected. Whether you're hunting for your dream home or just curious about where the market's headed, keep your eyes peeled. The next chapter is already being written, and it's moving at lightning speed. For anyone who lived through the housing meltdown of 2008, today's market might look familiar at first glance. But don't be fooled. The ground beneath our feet has shifted in big ways. To really get what could happen next, let's walk through 5 key differences between then and now and why they matter more than ever. Back in 2008, home prices were about 35% above what history told us was normal. Today, we're staring at prices nearly 80% higher than long-term averages. Think of it like stretching a rubber band twice as far as before. Eventually, something's got to give. That extra stretch represents trillions of dollars worth of phantom equity floating in the system. When reality bites back, through job losses, credit tightening, or simply people refusing to pay inflated prices, experts estimate we could see home values drop by 35% to 45% nationwide. For someone who bought at the peak, that's a jaw-dropping hit. And for those still on the sidelines, it could mean bargain hunting opportunities, the likes of which we haven't seen in over a decade. Remember how mortgage rates tumbled in 2008, giving struggling homeowners a little breathing room? That's not the story today. Over the past 3 years, 30-year fixed rates have more than doubled, from the low 3% range to over 7.5%. Picture a homeowner who locked in a 3.5% rate 2 years ago. They're sitting on a golden ticket. Why would they give that up and trade it for something more expensive? The result is a lock-in effect where people stay put, even if their job or family situation changes. It's like being stuck in a comfortable old sweater you can't take off, even when it doesn't fit anymore. This frozen market means fewer homes for sale, but it also means that when those rare listings pop up, they'll face a crowd of buyers who can't or won't find a better deal elsewhere. In 2008, millions of young adults, millennials, were hitting the marriage and baby years and flocking to buy their first homes. Fast forward to today, and birth rates are dropping, population growth has stalled, and baby boomers are moving toward retirement. That combination is like taking the wind out of the housing market sails. Fewer first-time buyers, plus more older folks looking to downsize, means the balance of who wants to buy versus who wants to sell is shifting sharply against sellers. Imagine a neighborhood where 5 years ago, every for sale sign had 3 sold stickers underneath. Soon, you might see just 1 buyer for every 3 homes on the market. And that ratio is expected to keep worsening through 2030, putting downward pressure on prices and turning real estate from a seller's dream back into a buyer's market. In 2008, your typical home buyer was another family like yours. Today, big investment firms own over 800,000 single-family homes across the country. These deep-pocketed landlords swooped in during the pandemic, buying up properties by the tens of thousands. Now they're tapping the brake. Acquisitions are down 70% and they're unloading inventory 25% faster. Think of it like a warehouse dumping thousands of new shoes onto a mall floor. Suddenly, shoppers have plenty of choice and can haggle on price. When these institutional landlords flood the market just as demand wanes, prices can slip faster than you'd expect. When the pandemic hit, working from home was a silver lining for many. You could move farther from the office, grab more space, maybe even a yard for the kid. But as companies call people back, 65% now require at least some office days. That dream home in the country becomes a commute nightmare. Suddenly, those once happy buyers turn into distressed sellers who need to be back near downtown, near transit hubs, near coffee shops and client meetings. It's like a game of musical chairs. When the music stops, everyone rushes back toward the same limited seats in the city, leaving the outskirts with empty houses and falling prices. The housing market isn't a standalone show, it's the opening act for the whole economic performance. When home prices tumble, consumer confidence takes a hit. People feel poorer and tighten their belt. Furniture stores, home improvement shops, appliance makers, and even local government, which rely on property taxes, feel the squeeze. Banks that lent on inflated values might get burned, leading to tighter credit for businesses and individuals. It's a domino effect. Wobble one tile and the rest can come crashing down. For anyone with skin in the game, whether you're a homeowner, investor, or simply planning for the future, recognizing these structural shifts is crucial. This isn't a rerun of 2008. It's a whole new storyline with bigger players, different rules, and unexpected plot twists. By keeping an eye on valuation gaps, interest rate traps, demographic shifts, institutional moves, and the WFH flip-flop, you'll be better positioned to ride out the storm or even find hidden opportunities when the dust settles. After all, understanding the full picture is the first step to making smart moves in any market, especially one as complex and high stakes as housing. Regional banks are sitting on about $3.6 trillion in real estate loans. Yes, that's trillion with a T. Now imagine home values slipping by 20%. Suddenly, we're staring at hundreds of billions in potential losses, all while banks juggle the highest interest rates in 16 years and a yield curve so flat it's squeezing their profits like a vice. Residential construction makes up roughly 3.2% of our entire economy, and it's already starting to shrink. Housing starts are down 22% compared to last year, and if history is any guide, that points toward 800,000 to 1.2 million construction jobs disappearing in the months ahead. These aren't just numbers, they represent real people worried about paying the rent or putting food on the table. Now let's talk about what a 30% drop in home values could mean. We'd see around $12 trillion wiped off household wealth, which works out to an average loss of about $90,000 per family. That kind of hit could shave $600 to $900 billion off consumer spending each year. That's roughly 3 to 4% of our GDP vanishing almost overnight, and it would ripple through every corner of the economy. If you've poured your life savings into property, this is your wake-up call. Many of us count on our home equity and rental income to fund our retirement. For the typical real estate investor, property makes up 30 to 45% of net worth. Lose a quarter to two-fifths of that, and you may have to delay retirement or drastically dial back the lifestyle you'd planned. And if you were hoping to pass your home on to your kids, a steep value drop could leave your heirs with far less than you intended, or force you to sell off cherished family properties just to cover expenses. Meanwhile, landlords face a double whammy. Rents may fall in a recession just as mortgage payments stay the same or climb, turning once profitable rentals into money pit. Here's how these downturns usually unfold. At first, demand fizzles out. Homes linger on the market longer, inventories swell, and sellers offer bigger incentives just to attract buyers. Several months into the correction, many sellers give in to reality and start cutting prices significantly. As financial stress mounts, foreclosures and short sales surge, adding a wave of distressed properties to the market. Finally, when values have dropped around 20 to 25%, big institutional investors switch from buying to selling, putting even more downward pressure on prices. There's also a hidden side to these numbers. Official home price stats only capture closed deals, so they miss all the repair credits, rate buydowns, and other concessions that buyers demand today. Real-world prices are likely 8 to 12% below the headline. Banks are reporting about 1.8 million mortgages in some stage of delinquency delinquency, with nearly 500,000 more than 90 days late. That shadow inventory of troubled homes will keep hitting the market through 2025 and 2026. Public home builders talk about 5.8 months of supply, but once you include homes under construction, the real figure is closer to 11.3 months, levels we only saw during past busts. The bottom line is clear. We're at the start of what could be the biggest U.S. housing correction in history. Sky-high valuations, falling demand, shifting buyer demographics, and shaky economic fundamentals are lining up like storm clouds on the horizon. If you've built your wealth on real estate, now's the time to face these facts and take steps to protect your nest egg. History shows that in every market cycle, wealth doesn't vanish. It moves from those who ignore the warning signs to those who pay attention. Which side of that transfer will you be on?